are done, come back, and at noon we'll be back. We'll be on for mentor.
Oh, I see. So do you want to log off or just leave this on?
No, just leave it on. Just
Okay.
Tim is hiding. Oh, there you
All right.
All right, everybody's back. Cameras on, and we're gonna let Raquel take the biggest part of this going forward, because she has so much to discuss. With being able to do your cost sheets is being able to, just like a doctor does x-rays and blood tests and everything, so you can see what the situation is, and your clients need to be able to see that. You need to be able to see it to know what kind of negotiating power they have and that you have. So working hand in hand with, not only working with your lender hand in hand, but also having that kind of knowledge and being able to speak to your clients about it. Because that's number one that's on their mind. What's it going to cost me? What kind of a check do I have to bring to you? Or what kind of a check am I going to get? So I'm going to let you just take it, Raquel, and you can open it up. And then if there's any other mentors, which I see a couple on here, any other mentors that join in the conversation, and feel free to chime in.
Yeah.
Okay.
First and foremost, I want you guys to realize that this is one of those things that you're just going to need to practice it over and over and over again. So if you, after 3 or 4 of these Zoom classes on cost sheets, or somebody helps you with one, you're still not getting it, don't worry. It could take, 5, 10, or 50 cost sheets, and all of a sudden your brain will just go, aha, like I figured it out. I'm not kidding. I think I was in the business a good couple of years, and it just finally took me asking various people the same question, getting the same answer, but in different ways, for my brain to kind of soak it up. Somebody asked if you can use the cost sheet that the lender gives, and you absolutely can. Absolutely. 2 things to keep in mind. You've got to be able to understand it so that you can explain it to your buyer. So I have no issue if a lender wants to give me a cost sheet, I have no issue using that, but I also want to go over that with my buyer so that we both understand exactly what's happening. And the other thing you want to make sure, are there fees on there that the lender did not put in? One of the biggest fees they don't put in, some are pretty, playing fair in the sandbox. The broker admin fee, which ours is $350. A lot of them don't put that in there. The ones that do are super cooperative with it, but some, I don't know if it's out of laziness because their cost sheets are already kind of pre-set up. But just make sure that you note that that's on there. And if you want to use the lender cost sheet, you can just add on there. Plus, broker admin fee, $350, and just have your buyer initial that and sign that cost sheet. But at the end of the day, you still have to understand how to put a cost sheet together and what the fees are and stuff. So when you're going through, you're going to talk with your buyers. You're going to ask them all kinds of questions, including what kind of loan are you going to do? Are you doing conventional, FHA, VA? If you're doing conventional, how much are you putting down? 5, 10, 15, 20%. If you're doing VA, you don't have to worry about the VA funding fee. That, or not the funding fee, but with VA, they get special, I guess you call it pricing, special rates and stuff based upon their funding fees, or on their, oh God, what's the word? Somebody help me out here. They get like so many certificates. I can't think of what the word is. Anyway, the lender will take care of all of that. All you're going to worry about is the actual loan side of it. As far
allowable costs.
No, there's a certificate that
you said it right. The VA, the certificate of eligibility.
There's it, certificate of eligibility. And the lender will be able to work with your buyer to make sure that they have enough eligibility left for whatever they're purchasing. And they'll know. That's a quick question, a quick search for the lender. With FHA, they have to have at least 3.5% of their own money in. So a couple of quick notes. On conventional, the seller can pay up to 3% of the buyer's closing costs. On FHA, they can pay up to 6%. And I believe VA is unlimited. It used to be 9%, but I think VA, they can pay, the seller can pay the whole closing cost for the buyer. But again, check with the lender on that. But again, when you're starting to talk even about 6%, you're really getting into a couple of things. A lot of money that the seller is paying for the buyer. You're also getting into questionable appraisals. When you're starting to raise prices and add 6% of closing costs and things like that, you really start to get into, is this house going to appraise for that? And that's the only way to answer that question is, house by house. Just depends. The prices that our houses sell for, this is my personal opinion, and this is a whole debate in itself. Years ago, we had a situation where people wanted to know if the buyer was getting costs paid for them. I personally feel like if the home appraises at, let's say, $225 and the seller paid $3,000 worth of costs, it didn't devalue the property in any way. So to me, it doesn't matter whether or not the buyer was getting costs paid. The house is still worth $225. So that's a whole nother discussion. But at the end of the day, the home has to appraise, even if the seller's paying costs. Any questions about that? That was just kind of a quick overview of that. Okay. I think what I'm going to do is I'm going to share my screen with you guys, and we're going to go over, I hope I pulled it up. Can you guys see this one? It says estimated buyer Burke 123, like high top. Do you guys see that one?
Yes, we can see.
Okay. So I personally have just an Excel spreadsheet that I created. I've always felt like some of the ones that the lenders use, some of the ones that the board has given us over the years have either too much detail. They broke things down so far that I think it was confusing for buyers. I'm just trying to give my buyers the overview. When you get a cost sheet from the lender's going to break it out a little differently. They're going to do it more from accounting standpoints. They're going to, give you all the money, take away all the money, and then here's what's left over. I'm just going to show you what the fees are and what you're going to be paying, and then what's remaining is what you're going to owe. Kristen Leal had sent, and Rhonda, you sent all those sheets last week, I think it was.
Right.
In one of those things, I think it was Kristen Leal has a cost sheet, and I will reshare it so that you guys have it specifically. It comes from.
That was from Brad at First National.
That was actually probably one of the easiest cost sheets that I've seen. I'm going to go ahead and break mine down. And then, like I said, I just think you need to know what you're putting in and what it means. His already had a lot of the lender fees put in. So his is great if you're going to use Brad, but if you use a different lender and they have different fees, you have to kind of understand where those fees go. So I think probably one of the hardest ones that we'll do is a conventional 10% down, because you'll have private mortgage insurance with it. I'm going to do that. And then if we have time left over, I'm going to touch base on FHA and the seller side's piece of cake. If that's good with you guys, let's just use this as an example. So if the purchase price on this house is going to be $225, this is what you're offering. This is the offer price. And you're going to do a cost sheet for your initial offer, the final accepted offer, and if anything changes throughout the process, you're going to want to have a cost sheet for that. So initial and your final offer when you submit your accepted contract. Does that make sense? If it doesn't, just somebody holler, just shout out. Okay, so in this case, we're going to do a purchase price of $225. Down payment is 10%, so their down payment is $22,500, which makes their loan amount $202,500. In this particular loan, it's 2.75 interest rate, and these are all going to be amortized for 30 years. I'm not doing anything special. This particular house, the taxes were $4,500, and we're going to try to close this one on March 31st. So I just put that kind of at the highlight, just to kind of, just kind of put the highlights of the loan, what kind of loan it is up there. I do, if you can, I don't know, can you see my mouse when I move it?
Yes.
I like to just put little comments here to the side, because I just feel like sometimes you just need to explain what it is or what it means. That's just me. I just, I can sit here and go over this stuff, but when you can go back and look at it is when it needs to make sense. And sometimes that little explanation is what triggers something in the buyer's mind, so they don't always have to call me or text me. I mean, I want them to understand this 3 days later, or when dad wants to go over it with them, I want them to understand it. Okay, so one of the biggest misnomers you're going to hear is you'll hear a lot of people say things like, oh, closing costs are only 2 to 3% of the house. Well, that's partially true, but what they forget to tell you is closing costs are only one portion of the fees due at closing. You're going to have your closing costs, and then you're also going to have down here, you've got your prepaids and your escrows. You've got to set up your taxes and insurance to be paid for out of your monthly payment. And that's where probably the biggest chunk of money comes from. So let's go over closing costs first. Closing costs are going to be your down payment. I lump together application credit and appraisal. The only reason I do that is a lot of times your banks are going to say, okay, in order to lock in your rate, we need a check for X number of dollars, which is usually the appraisal and the credit fee. So it's usually like $400 to $450 for your appraisal, and then credit reports usually run around $50. And then anything that's left over, banks will charge you like whatever the actual rate is. So if your credit report was $27.50, all the rest of it will go towards a credit to whatever you owe. I went back through, when I did this for an ATA, I went back through, I think about 6 or 7 different closings, because somebody had mentioned to me that she felt like my fees were too high. First and foremost, I like to overestimate, and I tell my clients that number one, I will overestimate because I'd rather have you think you're bringing this and it's only that. The other thing I tell my clients, always, we are going to refer to the lender for things like application credit and appraisal fee and loan company fees. And the reason being is because Wells Fargo charges something completely different than Dundee Bank. And every lender's a little different. So depending on who your buyer uses, that's when you want to be able to look at that cost sheet and either use that, compare it to this, or just be able to talk intelligently about the difference. Most buyers get it though. I mean, they understand. They understand you're just giving them an idea of costs. Out of the, I was like 6 or 7 of them that I went back and I just did a quick spreadsheet of them. The costs were like all over the board. I was really surprised. So I went ahead and just left mine alone. Again, your appraisal is probably going to estimate about 400, unless you're talking about, you know, a 5,000 or 6,000 square foot home, but your average 2,500 square foot home, you know, so to speak, is probably going to be about $450. Credit reports usually run anywhere from 25 to 50, depending on the bank. Application fee, lenders can charge all different kinds of fees. There's nothing that says they can't charge all the fees. I think US Bank is probably one of the worst. They can do an application fee, a processing fee, tax service fee, underwriting fee. I can't even think of the other, I've seen on there. Anytime you see something like a discount point or an origination fee, those are usually fees that the buyer, well, a discount point, the buyer has chosen to pay that to buy the interest rate down, which may or may not be a good idea. And an origination fee, some lenders just charge an origination fee, which is usually a percentage of the loan. That's just how they do business. So that's, again, just knowing who your lender is and what those fees are. One of the cheat sheets that we shared with Rhonda last week, and I'm going to share you actually that same one, but an updated version, actually has Dundee Bank's like their cost, their processing fee, their administration fee, credit report, and everything right there. So in my opinion, I would just utilize Dundee Banks because that's who we've partnered up with. Even if your lender's going with First National, US Bank, Wells Fargo, whoever, use Dundee's as the guideline. And that will keep you, you'll be within enough of a range that you'll be fine. Okay, so you're gonna wanna give them an idea of what those costs are. Survey usually runs around $85. I did have one last year that was actually $92.50. I'm not sure why. So I just go ahead and do survey and termite both at 100. Both of those realistically though are going to run about $85 for inspections. I do put the survey on here unless I know for sure we're not going to do the survey. Otherwise, I just put on there it's waived if not required by the lender, if that's what we put in the contract. So that's when you just want to make sure that if your buyer wants a plot plan survey, which will pull up 2 pins, and they'll pull up a front and a back, and then they'll make a square out of it. That's going to run around $85 or so. If they're going to plan on putting a fence in, or maybe they need a full-blown boundary survey for some reason, you're talking $450 plus, and I would just call and get a quote. A lot of times, by the way, your boundary surveys will be required to be prepaid before the title company will send those out. So what would you guys say? I'd say probably 95, 98% of them are just a plot plan or waived if not required by the lender. I'm not seeing that many lenders require them anymore. Termite inspection, that's just for the inspection. If your buyer chooses to do a whole house inspection, if they don't, just mark it 0. I put in there, it runs around 400. Again, if you've got an extremely large home, you may need to call and get a different price, but your general home is going to run probably 385 to 425 for just a basic whole house inspection. With a new contract, if you do choose to do an HVAC inspection, a sewer line inspection, you need to put those on here. You need to make sure that you call and find out. A lot of HVAC companies used to charge around $95 to do an inspection. So just double check what it's going to be and put those on here. To record at the courthouse runs about 100. Title insurance, this is only going to be the buyer's portion. I always do expanded coverage, which I just realized is spelled wrong. I always do expanded coverage. That's what I default to. In my opinion, you're talking maybe $100 extra for the best coverage that you can get. To me, it's absolutely worth it when you're talking about insuring something that in this case is $225,000. It's a no-brainer. I just put on here,
Raquel, just since these new agents have not, they probably don't even know much about the
I was
difference.
going to ask the same exact
Expanded-
question.
okay.
Can you just give your brief version of that real quick?
So this is how I describe the difference between basic title insurance and expanded title coverage. So basic is going to cover you up until the very day of closing. They're going to do a final quick title search prior to closing. If for some reason a contractor were to, and I just have that little cheat sheet. It's in my to be filed pile and I moved it from this. There was a cheat sheet that just came out that Nate gave for, oh my gosh, what did I do with it? Anyway, he came out with it and it has a whole list of all the reasons, like everything that's covered under basic and everything that expanded would cover. If a contractor were to do work and not file until, let's say, the day of closing, there's a possibility that title insurance under basic would not cover that, but with expanded, it would. A good example, which I did not even realize title insurance would cover this, during the escrow closing period, there were some windows that needed to be I believe they found out from the inspection, that needed to be replaced because they were bad. So the seller replaced them. They closed, the buyers moved in, and then after the buyers moved in, the HOA contacted them and said, hey, thanks for the new windows, but they aren't up to our covenants. And so it is now upon the buyer to actually now replace the brand new windows because they didn't meet the subdivision's covenants. Title insurance actually covered that. I never would have thought to contact the title company regarding that. That blew my mind. But if you've had to replace some of these big windows can run $1,500, $2,500. So, and from what I understand, I think there were 3 or 4 windows that the sellers replaced. So
Yeah, that's pretty impressive. I've had 2 that I've had to use but expanded title. One was they were both in the suburbs. One was because the sellers had painted the house and it wasn't the right color.
yeah,
And the other one was they put a new mailbox up and they put it on the wrong side of the street. And so both times that expanded policy covered the difference. So
the mailbox is on the wrong side of the street and there are children starving in our world. That cracks me up.
I had sorry, go ahead.
No, go ahead.
Oh, I was just gonna say I had one. Some buyers bought out in Fremont. They had like an acre of land. The lot next to it had nothing going on. After they closed, neighbors showed up 6 months later and said, hey, I'm going to do something on my land. And it appears that your shed is on my property. So title insurance would cover the cost of taking down that shed.
Oh, wow.
Yeah.
That's
Yeah.
impressive.
Yeah.
I mean, so right there, you guys, in my opinion, and there's a cheat sheet. I'll scan that and include it just so you have it, in the same email. Nate had sent that out, which was a fantastic, here's everything that basic covers and here's everything else that expanded covers. And in my opinion, again, you're talking about maybe $100 difference. And you're talking about in this case, a $225,000 property. I'm sure, Sheila, like the property out there for an acreage was a lot more than that. To me, it's a no-brainer when you're talking about protecting your investment. So
Raquel, can I ask you a question?
Sure.
I was just wondering, in your opinion, what would be an appropriate time to just recommend basic title insurance? I had someone mention that if it's the purchase of a new construction and there have never been any other owners other than the builder, is it necessary to have expanded coverage in that?
Yeah, I would, and Tim and Carol, correct me if I'm wrong on this, but my understanding, so expanded coverage has always been an option, and it did not really kind of come to the surface until years ago when the owner of Benchmark, it was like a celebrity home builder, a little higher end. He had, I can't remember if he committed suicide or if he, I think
Yes,
he was
he
murdered.
did.
Committed suicide right before the crash happened.
Yeah. Come to find out, he had multiple loans on the same property. So I had a realtor friend who actually had a closing that did occur. So she was pretty happy that hers occurred, but then came to find out that there were multiple liens on that same property, which I'm not even, my brain doesn't even fathom how you could do that. But somehow he was able to do that. And then because of that, contractors were coming out of the woodwork, putting liens on properties. Now, obviously, like, you know, the city got involved and, you know, said, we can't, you know, we've got to do something to make this right because we can't put this on all of these people. But in a new construction situation, I really think that for an extra $100, I would rather have it be covered for anything and everything that I can get it covered for. Because if for some reason there's a dispute between the builder and the contractor, and that contractor goes and puts a lien on that property, your buyer could then ultimately be responsible for that. I actually had new construction clients that fought the fact that their roof was not put on properly. The builder would not fix the roof. We had roofers, inspectors, and everybody out there saying it was not done right. So they paid to have a brand new roof put on. Well, the initial roofer never got paid for the roof. And he put a lien on the property, and it's all been settled now, but that was an interesting situation. So, you know, luckily theirs was settled, but yeah, I would absolutely do expanded coverage every time. I just think at the end of the day, you just don't know what you don't know. I mean, if I know what somebody's going to do, or if I know that the neighbor has an issue with my shed being on their property, or your fence is built on my property, you know, if you don't know that at the time of closing, it's fine. But when it does become known, it can be a real mess,
You know, I know you're going to move on, but to not to be like this dead horse, but I will say when it comes to title insurance, it's insurance. You want as good of a policy as possible, just like errors and omissions insurance. You want as good of a policy as possible. You hardly ever use it, but when you do use it, you want a good policy.
That's exactly true. Yeah. You don't need it, but when you do not want to be skimping. Because again, it's your home. You know, it's, you know, if it was your car, you can just go take the city bus. The Orbit has plenty of room, by the way. Okay.
Hey, Raquel, can I ask a quick question?
Sure.
So as you're going through this, so I have a buyer right now who had a whole house inspection done, and the whole house inspection then indicated that they needed to get the sewer line scoped.
Okay, and that's pretty typical of a lot of inspectors to suggest further inspections. Sure.
But did I understand right? Should I have gone back and changed their cost sheet for that, or am I good? Just because I think they already paid for it.
No,
okay?
I wouldn't at that point. At that point, they already know what the costs are, and then they're choosing to add on more. It's not
Okay, thank you.
unusual or exceptional. No.
Okay.
Okay, so title insurance, and because we're on Zoom and stuff, if you go to Green Title, there's a lot, in any of our title companies in town. I use DRI Title, which is Green Title's like parent company. That's what I've always used. Oh gosh, Title Core is another great one. Just when you get a free minute, just type in Title Companies of Omaha, go to Green Title first, but you'll be surprised. They all have a title calculator that you can just literally type in the purchase price, how much, you know, is the loan amount, like the down payment. Do you want an owner's policy? You do want to do an owner's policy. The lender is only going to worry about the lender's portion of it. The owner's policy will cover the difference. So you do want to include the owner's policy. And then it'll just ask you, do you want us to include the escrow closing fee? I don't know why, I always do, but I separate it here. So what it will do is it'll give you an estimation of what your buyer and seller costs are going to be. And then depending on who you're representing, you can see what your portion is going to be. So that's the easiest way to do it. I have like an old cheat sheet that just kind of gives you, price ranges, but with everything online now, I just quick run to the title company, do a title calculator, type it in, and it'll come up and like, in fact, on this one, I think it'll show 542.50 is what the title ends up being. So I just estimated at 550. I separate out my escrow closing fee. So the title company is going to charge you an escrow closing fee to do the closing. The lender is also going to charge a closing fee, which is usually about $250. Even if the title does all the lender paperwork and the title paperwork, your buyer is still going to be paying a title closing fee and a lender closing fee. So when I do my loan company fees down here for $1,000, that is anything from a processing fee, underwriting fee, tax service fee, origination fee. So, and honestly, you guys, the answer to what those fees are, usually a tax service fee won't be more than $65 to $85. I think Dundee Bank charges, they charge $79 on their little cheat sheet. Underwriting and processing fees, those can be anywhere from $100. I've even seen them as high as $300. So that's when you want to be able to get a copy of your buyer's estimated cost sheet. A lender can give your buyer an estimation of a cost at any given time. You do not actually have to have an address. They'll just put in the system, address to be determined. So at any point in time, I just had one recently. I said, hey, can you get us an estimation of their cost? So we're in the process of like literally scrutinizing what the cost sheet means, exactly how much they need, how much their house is worth, so that when we do find them a house, they already know what to expect. For them, it's literally just finding the house. They know exactly how much they're going to have to bring if they spend this versus that, and what the processing fees are and everything. So again, I just lumped together loan company fees of $1,000. You're more than welcome to split them out. If you use the cost sheet that Kristen supplied, it automatically feeds in the loan fees. You'll see that when you hit submit, it'll take you like straight to a PDF, and all those fees were already included. But I do think it's important that you need to know what's all included in that. And can you see my picture, my face? So you can see me doing this. This is page 2 of this little cheat sheet. They've broken out by FHA, VA, and conventional. This will be a good one to just refer to until you get used to what they charge. I do recommend when your buyer gets close to closing and you get the final, I still call it a HUD statement. I think it's called now the ALTA statement. The final statement that says you're going to bring with you $23,127.16, the actual final amount that they need to bring the check. Go through that with a fine-tooth comb. I actually take that and then compare it to what I told them so that I can see what the differences are, and to see how close I was so that I can kind of learn and keep my fees together. And again, if you start to feel like you're estimating too high, back off a little bit. If you don't feel like you're estimating high enough, figure out where you need to add those buffers. And I do go through mine and make sure that everything calculates out correctly. And don't forget, if the seller's paying costs, maybe after the inspection, instead of doing a repair, they're going to pay some buyer paid costs. Make sure that that's on that cost sheet. If you asked for a home warranty, you may not get a seller side. So just clarify that the seller is being charged for the home warranty. Sometimes I get both sides. More times than not, I get just my buyer's side if I'm on the buying side. So just verify. I have seen it before where it'll say home warranty, but it just won't say a charge. That just lets you know that, yes, the title company is aware there's a home warranty. So just, double check those things as you're going through. If you know there's discount points, you're more than welcome to put them in here. But, a lot of times it's, this is a lot of those questions you have to ask your buyer and the lender that they're working with. And the lenders are more than happy to do a cost sheet. They're more than happy to do a cost sheet and send it over just based upon whatever they're pre-approved for. Or if they're pre-approved up to 300, they only want to go to 275, they'll do one for 275. Just communicate with them. I do on a closing cost, I do like $100 miscellaneous. That's going to be things like your flood certifications, only $19 usually. If the lender or somebody charges like a FedEx fee or a wire transfer fee, those can be $25. Funny thing is, I think Wells Fargo charges $50 for a wire transfer, and then they charge $25 for a payoff, which I find humorous. But this is just like a miscellaneous buffer. If I have a house that, let's say, is $100,000, I usually bump the miscellaneous down to 50. But again, it's just, it just depends. It depends. Any questions on like closing fees, just general closing fees? Okay. And then you get the fun part. So in this case, your closing fees, and then when I tell the buyers, I said, okay, so your closing fees, including your down payment, would be about $26,150. Now we get to set up your prepaids and your escrow. This is the fun part. Okay. So and everybody's aware that when you make your payment on your standard residential loans, your taxes and insurance are also included in that payment. So a portion of your monthly payment is going to go to your escrow account. Twice a year, the bank is going to pay your taxes. Once a year, they're going to pay your insurance. The best way to remember taxes, the taxes are going to be due January and July. They're not delinquent until April and August. So you'll find out that a lot of banks will not pay them until the last minute. But for the most part, just remember they're initially due January and July. Your insurance is going to be due whenever you purchase the home. So if you purchase the home in May, it'll be due the following May. So you'll see if you look at an escrow sheet, there'll be 3 payments, 2 tax, and then 1 insurance, 1 big lump sum to insurance. So what we need to do is we need to set up that escrow account. So keep in mind, when you close on a property, let's say we close at the end of February. So we're closing February, well, in this case, we're closing March 31st. So the buyer is not going to have a payment during the month of April. So their first payment is going to be due in May. So what happens though is come July, 2 months later, 6 months of taxes are due. So if you follow me here, we're closing March 31st. So we do not have a payment in April. Our first payment is May. So in May, we're going to make a payment to the bank, and a portion of that is going to go into our escrow account so that when we have bills due, we'll have enough money in that account to make the payments. So my buyer is making a payment in May and June, but the problem is July rolls around, and in July, with the July payment, I only have 3 months worth of taxes in my escrow account, but I have 6 months due. So I somehow have to make up the difference. And then you always want to have at least a month or even 2 months buffer in those accounts in case taxes are raised. So what you're going to do is, and I always use 8 months. 8 months will almost always get you right on target. A portion of 8 months of taxes is going to go to reimburse the seller for what they've paid. And the remaining is going to go into the escrow account to get it set up so that when taxes do become due, you've added 3 months, but you'll have enough in there to make a full 6-month payment. In Douglas and Sarpy County, we treat taxes as if they are real time. So if you close the house March 31st, the seller has already paid for the first half of taxes. So they've paid for the taxes from January to June. You're going to reimburse that seller for April, May, and June. Does that make sense right there? Okay, so what you're doing is you're reimbursing the seller for the portion they've already paid for and they're not using. So that's 3 months, so April, May, and June. We've already found out that we're about 3 months behind. So that's when we make our own payment in July, we're 3 months behind. So now I've got 6 months of taxes in there, and I collected 8 months at closing. So those other 2 months are my buffer. Is that clear as mud to everybody? Yeah.
So you're describing this very well, as best as I've ever heard anybody describe it. It is a shit show. For the fact that you're able to describe it this well, You're great.
I know,
Keep on
I'm
going.
blown away. I can't even like imagine that you could know that all that.
Did you
This is
used
one
to
of
be a-
those.
Did you
I
used to be a
remember
closer?
seeing, what?
Did you used to be a closer?
No. Oh my God, no. I remember, I don't know who it was. I was at 132nd and some agent walked by and I'm like, hey, can I ask you a quick question? Because like my mom and dad weren't around and I was just like, I was like a doe in headlights. I'm like, oh my God, I have to get this to them tomorrow. And that was explained to me. And that was when like the light bulb went off. I honestly, you guys, cost sheets are a piece of cake, except for that stupid tax thing. All it comes down to is you have to reimburse the seller for what they have paid for and they're not using. And then the rest of it goes in to set up the escrow account. And if you sit down and realize when you're closing and when their first payment is going to be, you'll realize this case, in this sample, they're not making a payment till May. So they're literally having May, June, maybe July. Depends on when the bank pays it because it's due in July, but it's not delinquent till August 15th. But so if they actually wait and take the July payment, the bank has 3 months of escrow. So somebody has to make up the other 3 months that are due, and you still want to have a positive balance in there. So if you do 8 months, a portion goes to reimburse the seller, the rest of it goes to set up your escrow and make, taxes paid whenever they're paid.
Raquel, can
Yeah.
you just confirm that this 8-month number kind of works no matter when the closing date is throughout the year?
Yeah, so let's say you close November 30th. So your seller has already paid 6 months of taxes and you're only going to reimburse them for December. Okay, so December is what you've reimbursed your seller for. Let's see if we can do this. We got 8 months, right? So your seller is getting 1 month taxes. Now you've got 7 months, right? You're not going to have a payment in December. Your first payment is January. So in January, you're going to make a portion of your payment to your escrow account. So now you're back up to 8. But January, you've got 6 months of taxes due. So there's your 2 month buffer.
Can I just
Yeah.
interject something here? What I would love to have is just that piece
Mhm.
done in a little video, just that piece right there. If
And
you do a little video that is
Yeah.
10 minutes long that we can upload, we could actually charge for it.
And I'll tell you what, and I told Kathy I would do this for her too. I'll make it with like a calendar behind you with January, February. I think I'm very visual.
Yeah, I am too. I was just gonna say, can you do this in some kind of a caricature picture?
I wish I have an old friend of mine that used to make cartoons for training seminars.
Yeah.
I wish he was still doing that because you just tell him what you want. He'd do the little guy that would just be like, doo, doo, doo. And then he'd have like little like thought processes and yeah, I'll put something together that makes it
great.
easy. Okay. Yeah, I'll
Thank
put something up there. And keep in mind, you guys, the only time that really deviates from that, first of all, communicate with the title company. I've never run into a title person that's not willing to explain what's going on. The only time that's ever going to deviate is, well, if you're not selling in Douglas or Sarpy County. If you're going, so our taxes, we use them and then we pay for them, but we don't sell real estate that way. Real estate, we treat them as if they are real-time taxes. Some counties around the country, and I believe, correct me if I'm wrong, I believe Lincoln does it this way. And then is Washington still collecting? I can't remember. What happens is in some counties around the country, sellers have to bring taxes current. So they could be potentially, in like the way we collect our taxes, they could be bringing a year and a few months of taxes current.
That is Council Bluffs. That's
Council
Iowa.
Bluffs? Yeah.
Washington County's that way too.
It is yeah. If you have a buyer
there's-
that's buying across, from Omaha to Council Bluffs or Washington, Lincoln, in or out of Omaha, you're going to want to get clarification for them, or at least help them understand this is how we do it here. It does not matter how they do it there, because they're going to collect however they do it. I want to say like Chicago or something, we had friends of, I don't know who it was that did this. They ended up having to escrow money from the seller because they had used, like they closed in the summertime, like June or July. So the seller had used 6 or 7 months worth of taxes, but they didn't collect taxes. It was up to the buyers to make that payment. So they had to escrow the money. So it was, to me, that was just like a nightmare to have all of this money in escrow. I don't know why, but we've always just treated taxes as if they're real time. I think it's the simplest way to do it. I don't think our taxes change enough from year to year to worry about having somebody be responsible. And then what happens if someone doesn't pay it? It's just, to me, that's a logistical nightmare. So wherever your person is moving from, if it's not Douglas or Sarpy County, you may need to just contact that county, like the realtor board there, or find out from the title company how they collect taxes so that you can help your buyer understand what's happening. And it only applies to your client here. If they're buying something in Lincoln, that's not your job because you don't work Lincoln. Unless if you do work Lincoln, then you would want to explain it. But I don't work Lincoln, so I don't. The only time I have an issue with it is if I have an out-of-towner coming in. It's just a little bit different for some people. Honestly, most people don't notice though. They don't. So in a nutshell, just remember 8 months, a portion goes to reimburse the seller for what they've already used. The rest of it goes to set up your escrow account so that when the taxes are due, you'll have a full 6 months in there plus a buffer. Homeowners insurance, we only set up 3 months. And the reason being is because you don't have a payment the next month. So when you start collecting for your escrow for insurance, it's not due for a whole year. So it's due 13 months, it's due 12 months later, but you're not making a payment. So if we close March 31st, we're not going to have a payment in April. So we don't start collecting until May, but next March or next April 1st, I should say, you've got 12 months of insurance due, but you've only got 11 months in there. So we're going to put 3 months in there so that when insurance is due, we'll have a full 12 months plus about a 2-month buffer. Does that make sense? Okay. And insurance, you prepay. So you're going to pay your first year of homeowners insurance. You're going to do 3 months to set up the escrow. Taxes, you do the 8 months. And then your interest per day is whatever your loan amount is times your interest rate. I do banker days divided by 360. I've had people tell me both ways, banker days or actual days. It is actual days. I've just always done 360. You're going to be within pennies anyway. So if you're closing in the middle of the month, you would do it times 15 days. In this case, we close on the last day of the month. You always count the day that you're closing. The day that you're closing, your buyer is charged for. And so with your insurance and your taxes and your interest, your prepaids in this case are $4,500. So the total amount due at closing would be $30,665. And then we get into the credits. So in this case, we did a $2,000 earnest deposit. That's a credit. Home inspection. I like to put the home inspection on the cost sheet so that they have here's all of the costs that you're going to be paying. In the case where you did a home inspection, Katie, and they did the sewer inspection after, you just talk with them, briefly about that. They get it. They know that that's not initially. But I like to put it on there and then just show them it was a credit because it was paid at the time of the inspection. And then in this case, I did an example where the seller is contributing 3%. It's just straight up 3% of the purchase price, which happens to be $67.50. So with those credits applied, the total due at closing would be $21.5. And you make sure that they're okay with that and they understand it. And then I show them what their payment would be. So to get principal and interest, I've said this before, there's a calculator that I love called Carl's. It's that one right wherever my finger is. It's right there. Do you see it?
I started using that, Raquel. It's great.
I love this. What was that?
It's so simple. I love it.
It is. Now I will say, I think if I remember correctly, and I apologize, I only used Kristen's cost sheet once. I believe it actually calculates out principal and interest. You're on camera. Oh, sure. He's at least dressed today. That was better than most. So I lost my train of thought. You have your principal and interest. Use that Carl's calculator. It is so easy.
You were talking about Kristen's.
Oh yes, thank you. I only ran through it once, but I think hers actually calculates out principal and interest for you. Which if you're in a pinch, that's a fantastic cost sheet to go through. My initial reaction to using that just one time, that was amazing. But I do think again, I just think it's hugely important for you to understand exactly how these costs are calculated and what's all included in those fees.
Wasn't that Kristen's, wasn't it Brad Dombrowski's from First National Bank, the one she uses?
Yeah, what I'll do is
A lot of people use it. A lot of
Yeah.
agents use it.
When we get done with this, I'll send you guys a bunch of stuff in one email. Some of
Okay.
that stuff was in that email that Rhonda sent last week, but I'll send it to you in just one email. So it's just kind of like, make
Yeah,
a
you can
folder.
send it to Rhonda and she'll send it out also. So
Okay.
Can I
So-
bother you? Sorry to interrupt. Can I
Yeah.
just ask a quick question while we're on that topic of
You bet.
Brad's? Because I have Brad's also, but have you noticed, I don't think there's a VA, there's not a VA one. There's like an FHA or a conventional, but I did not see a VA one. And I had to do a VA one last week. So I was searching and
VA is not that much different really than your conventional.
okay.
The biggest difference you're going to run into with your VA is the interest rate, and their closing costs are like next to nothing. On the seller side, the seller pays the termite and the escrow for the buyer. So those are two fees that the buyer does not have. Otherwise, you could just do a conventional. And I think if you look on the conventional, I think it's a drop-down box. I think VA might be one of the options.
Okay.
Now,
Got you.
like I said, I just kind of ran through it once because I saw that there. But yeah, it's for the most part, you could just do conventional and just on the selling side, no, there's no termite, or let me rephrase that. On the selling side, they pay the termite and the escrow for the buyer. Okay. On this particular one, since we're doing 10% down, we are going to have private mortgage insurance. So we have our principal and our interest, which you can figure on that Carl's mortgage calculator. You can also you can just Google mortgage calculator. Bankrate has a great one. Your taxes, your insurance, your private mortgage insurance on this little cheat sheet, and I'll send this to Rhonda. This was in with the information. This is the newest one that I just got from Nikki this morning. You're going to figure out what your mortgage insurance is. In this particular case, for a 30-year mortgage, the mortgage insurance factor is 0.0046. So you would just take the loan amount times 0.0046 and divide it by 12, and you come up with 7763. And that's where you'll just use this cheat sheet. I don't do enough more. I mean, it feels like I go in and out. Like all of a sudden I have everybody has 20% down. Then all of a sudden I've got all of these, 5%, and you just figure out what your factor is, and it explains exactly how to do it right here. So just remember, anytime somebody is not putting 20% down or they are doing FHA, there is going to be mortgage insurance. Remember, with conventional, once the buyer reaches 80% of value, they can get the mortgage insurance removed. They do not want to do it on their own. They want to contact the lender and find out what the lender's process is. But once they feel that they've had enough money put into it, either by payment or the values going up, time, and that's something to keep in mind. That's a great way to prospect. If you've got old clients that bought a house 6 or 7 years from you, before, you can go back and find out who had mortgage insurance, and that would be a great way to contact them if they haven't. You could just do a quick CMA for them and then have them contact their bank. Don't have them contact an appraiser because the bank is going to want to initiate all of that. So anyway, there's your total monthly payment. Any questions about that one?
Sort of. It's
No,
it's in the realm. So my clients have a bridge loan. Is that something that I need to put in here anywhere? I wasn't sure how to show them that, no, you don't actually need to bring this much to the closing table.
I would talk to the lender about that. Usually with a bridge loan, that's so that they don't have to sell their current home.
Right.
And then once the current home is sold, it's tied to. So in my opinion, I would not put that here because this is based upon the purchase of 123 Main Street. 672 Elm Street, they're still going to own. Any loans on that are tied to that, and that's not what you're doing.
Gotcha.
Yeah,
Thank you.
that would be for the loan. Yeah. I'm going to show you one other quick thing, and I apologize. Let me. Wanted to. Whoops. I'm going to try. Okay, so why is it not? Oh, I already had it open. That's 10%. Okay, can you guys see this right here? This says FHA loan. So, okay, and I know we're kind of getting close on time here, but when you're doing an FHA loan, the biggest thing you're going to run into is your buyer is going to have an upfront mortgage insurance, which is 1.75% of the loan. On FHA, they have to have a minimum of 3.5% of their own money. So if we were to take that same house at 225 and they wanted to put down the least amount of money, so the seller can contribute up to 6% of the purchase price as long as the buyer has 3.5%. So in this case, the buyer has to have 78.75 into the home. So the loan is 217,125. Then you take that times 1.75%, and that is what you call the upfront mortgage insurance, which in this case is the $37.99. You add that into the loan, and the new loan amount is now $220,924. Does that make sense? So you have an upfront mortgage insurance on FHA, which is 1.75%, and that gets added back into the loan. And that's on the little cheat sheet too, just FYI. And then the fun part is, and your fees and stuff for the most part are going to be the same. Your FHA appraisal is probably going to be a little bit more. I know Nikki has, actually she has FHA at 500 and 500. You know, again, look at your cost sheets as you guys go into this. Your final closing statements. Like I said, I pulled a few of them and I actually didn't have any consistency. My conventional loan ones that I had were anywhere from 385 to I think it was 535 or 565. They were all about the same size of home. So it just depends on who they use, you know, could have to do with credit scores, all kinds of stuff. But for the most part, your fees and stuff are all going to be the same, with the exception of you're probably going to have on FHA, you don't have a tax service fee on FHA. Otherwise, you know, your survey, your termite, all of that stuff's about the same. The one thing that you do have, if you notice here at the bottom, well, in this particular case, we did the seller could pay 4% just to show a difference. Again, the seller can pay up to 6%. But remember, you need to do the FHA VA amendatory clause that states that yes, the home has to appraise, in this case at 225, or the buyer can walk away and get their earnest money back. Someone had asked if they could pay the difference. So let's say it only appraises at 200. They can absolutely make up the difference. The FHA or VA may ask for a reason, like where that money is coming from, which they can, but they can absolutely make up the difference. In this particular situation, if you were having the seller pay costs for you and the buyer could make up the difference, I would think that's probably a red flag or a little odd, but at the end of the day, it is possible they can make up the difference. That probably isn't going to happen though. Just, you know, more times than not, the reason people do FHA is they've got good credit, but not a lot of cash on hand. And that's the benefit of doing FHA. With FHA, you do have to add in that mortgage insurance. there's a separate FHA, and you'll notice at the bottom, so like here's the conventional, here's FHA. They have a separate mortgage insurance factor, calculated the same way, but do know that with FHA, that is for the life of the loan. If they have this loan for 18 years, they're still paying that mortgage insurance. So if you have somebody on the cusp of doing FHA versus conventional, that's something to factor in. You know, they're going to want to refi this, you know, hopefully at some point in time. Otherwise, they're paying $150 a month just to have that loan, which if that's all they can do, then that's what they do. But if they're on the fence between FHA and VA, or I'm sorry, FHA and conventional, I would mention this and probably push them towards conventional. Again, unless they don't have a dime to their name and they need to only be able to put 3.5%. And I don't know, but there were a few banks for a while that had a 3.5% conventional. So again, talk to the lender. You know, you never know what programs they have. And then any questions about that? And then the
Could
seller,
you repeat that part about the mortgage insurance for an FHA? You said that that's, you can't end that at any point, even after you reach 20%. That's
yes.
a forever thing.
So conventional loans, if you're doing mortgage insurance, because you're putting less than 20% down, so you're doing 5, 10, or 15%, you pay the mortgage insurance until the loan has 80% to value, until basically the buyer then at that point has 20% equity in the home, whether by their own money or by the market increasing. Now the bank is not going to reach out and say, hey, Katie, you've owned your home for 6 years and the prices there in Omaha have gone up, 7.5%. We aren't going to charge you that anymore. They're going to keep their mouth shut and charge you as long as you allow them to. So it's fantastic for someone who's been in their home, 5 to 7 years, to really sit back and say, hey, wait a minute, have you refinanced? If you haven't, let's look at this, because if you're not moving anytime soon, refinancing to get rid of that could definitely be beneficial to them. So they can get rid of it once the home has 80% equity. Depending on the length of time, some banks I do know have like a time period. I think once like 10 years rolls around, they just automatically drop it if you call them. Some banks require the buyer to have an appraisal. And again, they're going to be in control of it. They're going to have one of their appraisers come out. And then as long as it appraises, then they'll drop it.
But
So
you're
that's why
right, with FHA, there's no removing of mortgage insurance.
It's for the life of the loan. So like I said, FHA is fantastic. And FHA is really a product that was designed to help, I don't want to say first-time home buyers, but that's kind of who it was more geared towards. But there's definitely advantages to FHA, especially if you don't have a lot of cash, but you've got great credit. It's a great way to get into a home if you don't have that cash. Because, closing costs are expensive, moving costs are expensive, but it's just very important. If you have somebody that can really only go FHA, and there are reasons why FHA is a little more forgiving than conventional in a lot of ways. If they can only go FHA, then that's what they have to do. It's more important to actually purchase the home and be a homeowner, in my opinion, than it is to not, because renting will cost you a lot more than $150 a month. But in this case, you just want them to know that, hey, if you're on that verge, like, I don't know what I'm going to do, and I don't really have an extra 2.5%, it's just simple math, you guys, just to figure out, okay, 150 times 12 times 5 years, how long before that $2,000 that we don't have, how long before we start, maxing out, and now we're, not recouping that difference. So it's for the life of the loan. Most people with FHA are probably going to move in 5 to 7 years, because it's usually going to be either a starter home or they're having life changing. They're getting married, they're having children, they're wanting bigger houses. So that's kind of the general idea. At least with most of my FHA buyers, most of them have moved on to bigger homes. Not always with me, darn it. But somebody
Well, we're
else,
right at one. Is there any final I don't even know if we could have a final to this, but any questions? Because we could do this for 3 weeks.
I'll
This is-
answer questions really quick. I'm going to send you guys, I'll send Rhonda this cheat sheet, the latest one. Just, this is your Bible. Keep it. Once you use it a few times. I use it all the time for the factors because I can never remember
Did
them.
you answer the question about Dundee Bank's costs? The cost sheet from Dundee Bank? Somebody asked about, Bridget asked about
So on that,
updated sheet.
on that cheat sheet, there's all of your
Okay,
conventional FHA.
there you go.
And then on page 2 is the Dundee costs. So I would use Dundee's until you get used to it, or
And if you ever have any specific questions, I'm sure that Raquel would always answer them. Just shoot her off a text or an email
just
and
call.
yeah.
Any chance I get to ignore my children, I'm all for it. And I will share with Rhonda, I'll put my Excel spreadsheet in there and I'll re-include Kristen so that they're all in one email for you, and then Rhonda can send those out. Oh, somebody asked about the first monthly payment. Generally speaking, and I'll use this to wrap it up. We close at the end of the month usually, or towards the end of the month, because whatever month you close in, you bring with you the rest of that month's interest. So interest is you am I going to say this right? You prepay your interest? No, when you make your April payment, you're paying for March's interest. Does that make sense? You
Right.
use the house and then you pay for the interest. So you bring with you the rest of that month's interest. So if we close this house March 31st, I do not recommend, by the way, closing on the very last day of the month, just because those are very busy days and it's easier to get the closing time that you want at least just a couple days before that. But you bring with you the rest of that month's interest and you do not have a payment the next month. Think of it in the way that the bank needs about 15 to 30 days to, get you set up in their system and get the mailings going out. And then by the time they're ready, they've already missed the mailer for that month. You can actually close, double check with the lender that you're using. You can actually close usually the first 5 days of any given month. And then the buyer can have the choice to either get a credit, like let's say they close on the 3rd of the month. They can get a credit for interest the first and second day and pay. So if we did, let's say we did it March 3rd, we could get a credit for the 1st and the 2nd and then make our first payment April 1st. Or we could choose to bring with us the rest of March's interest and not have a payment until May, which is really cool because if you think about it, yeah, you're bringing the rest of that month's interest, you're going to pay for it no matter what, but you don't have a payment now for almost 2 months.
Yeah, and I try to close usually in the first part of the month to take advantage of that. But you're going to pay it either way. It's just where and when you pay it. So
yeah, and the best thing I love about that is that if you've got somebody that's say month to month or had to give notice at a rental property, you don't have to be out till the end of the month. Why wouldn't you close on, let's say, March 3rd? If it works for everybody. Now you've got all the rest of the month of March to paint your new house, move in slowly, clean the old one, whatever. And then you still don't have a payment for April. It's kind of like a vacation. And I don't know about you guys, but I've seen people move with like 3 small children with 3 beds and bunk beds and toys. I don't know how people do it. I tell my clients all the time, I only had my husband and I to move. I don't know how people do it in a weekend. I really don't. I'm blown away. So
yeah,
holler if you guys ever once you guys start getting into actual situations, it'll start to be more real and it'll start to soak in. Seriously, don't ever hesitate to call me, or anybody in this brokerage will help you.
right.
But holler.
And thank you to the mentors that joined us. I know Terry just got off, but also Terry Pruitt is here, and Sheila, thank you so much. Did I miss anybody else? No, I think the rest of you are all in the newbie group. So thank you so much, Raquel. You're just you're like at Google.
Well,
Google for title. And I really
tell my children that, would you?
Yeah. Well, I was gonna say before is like between Tim and I, we have like 45 years in this business, and neither one of us know it as well as you do. And I just think the way you put it in simple form. Did you guys learn something today? Yeah.
Because my saying, honest God, if I could have one saying in life, my favorite phrase in the world is, okay, we need to dumb this down.
Yeah.
Like, we need to dumb it down.
Yeah.
When I'm talking to my accountant, I'm seriously looking at her going, no, we need to dumb this down like even further.
I love that. Yeah.
Yeah.
Yes, exactly. And somebody can lose, if they'll lose me in like the first 30 seconds.
Oh, and you never get back.
Same thing.
Yeah, I'm gone.
Stop.
Yeah. So call me whenever, text me, holler, I'll help you if I can.
Dr. Seuss kind of language.
No shit. Yeah, if you could rhyme it for me, that would even be better. That reminds me.
Eggs and ham. Give me
I'm gonna send you a
eggs
funny.
and ham.
I'm gonna send you a funny Dr. Seuss thing that you're gonna love, and
Max love Dr.
I'll
Seuss.
send it to Rhonda. She can share it with you guys.
I know them all really, really well. Everything Dr. Seuss and everything Barney. Like,
Oh my God. There's one that I love, and it's Fox and Socks, and it's like 10 minutes long.
yeah.
And you will find yourself stopping what you're doing because he about halfway through, he starts getting so good at it. Like it's faster and faster
Yeah.
that you just find yourself ignoring, like the house could be on fire and you're like, yeah, wait a minute. Just a minute. It is, I'll find it and send it to you guys.
Okay.
right.
See
Bye,
you
guys.
next week. By the way, you'll get instructions on what you're supposed to do next week. Next week is week 5 for 400 Days to Greatness, developing your online, offline strategy. So mentors, join us. Agents, join us. And in between, you have homework from week 4, and really take a look at your thing you just wrote out. So that would be something that's going to keep going on, and add to it, take away from it, do whatever you want with it. So, all right. Thank you guys for 2 hours of your undivided attention. Okay. We'll talk to you all later.
Bye, guys.
See you tomorrow.